The interest rate rises, since you raised rates last month, to what extent has that increase been passed on to consumers? Dr. Carney, do you want to lead on
Sure.
that?
Start on that, which is the two sides of the equation, as you're aware, borrowing costs and rates for depositors. Historically, what we have seen in this economy, and it's more or less true for other economies, is that the rates move relatively quickly through the borrowing costs with a bit of a lag to deposit costs, or deposit rates. Rates. And
it may soon be deposit costs.
Yeah, exactly. That's part of the story, and I'll come to that. But what we have seen is, obviously, with variable rate mortgages that are tracked to bank rate, obviously instantaneous, those that have SVR rates relative full pass through. On the fixed rate side, fixed rate mortgages that refer to whose rates are based more on market rates. What's happened with new rates there is that as markets had anticipated that it was relatively likely that rates were going to increase, that it wasn't fully priced in, but as picked up, the reference rate, the OIS rate, had been going up, and therefore there had been a steady increase in that element of those mortgage rates. In the context, though, of pretty heightened competition in mortgage markets as a whole, which have dampened that a tiny bit. But if I can, and we can send you the precise numbers, but more or less complete pass-through on as we would expect is the best way to say it, given there's a bit of a lag on the fixed rate side. On the mortgage side, you don't see much on consumer credit because, quite frankly, the rates are so high, and it's really driven by the riskiness of that lending as opposed to the shorter-term borrowing costs. You don't see much there. For small, medium-sized enterprise and corporate borrowing, more or less in line with what I said on the mortgage side. So you see the pass-through there. On the deposit side, we are seeing thus far, and it's very early days, and I would say, if we could have had this hearing for a couple of reasons. If we could have had this hearing a couple of days later, I would have preferred it. But one of the reasons why is that we would have had the quoted rates report, which comes out on I think the 7th or 7th of September. And so that'll give us our first look at, in an aggregate basis, we have evidence from supervisory evidence and others, but on an aggregate basis where the pass-through is. Our expectation is, given history and the low level of overall rates, is we'd see about 40% or so of the rate increase. So think 10 basis points as opposed to 25 on deposits. Varies a bit between instant and term. Why is that the case?
A lot of consumers will legitimately.
Well, exactly, and I understand consumers, legitimate concerns, and I should say that real concern of consumers that they have suffered for a long period of time with very low interest rates, and looking for a return on their money. Now, one of the things that has happened over the course of the last decade has been that historically you would have bank rate above the rates paid on deposit. And as bank rate went from 5% down to 0.5%, and then a little lower, that relationship flipped. So it went from 1.5 percentage point spread to about 30 basis points where bank rate was below the deposit rate. So the margin that banks and building societies were making was compressed by almost 2 percentage points if you add the two up. What's happened since is that some of that spread has been restored. So it's gone up to about 30 basis points. We'll find out later this week how much, where that's moved since. The big question, I'll finish here and head back, I'm sure you have follow-ups, is, well, what does that say about competition in the market? What is it? Should I lead on to that? Or?
Yeah, I think it would be helpful, because obviously that would be a legitimate consideration.
I think
the banks
it is a consideration. It's not a consideration for the MPC, obviously, and it's only secondary consideration for the PRCs, or primary consideration for the FCA, the FCA, as you know, and the Competition Markets Authority. I think when we look at it, our question is, so if you think about that spread, and I'm only using one spread as an example, that bank rate spread to deposit used to be 1.5%. It's now at 30 basis points. Will it go, of course, we have to raise rates more over time, but will it go all the way back to 1.5%? If it does, it means there's been no real shift, all things being equal. There's been no real shift in competitive dynamics. we think that there should have been some improvement in competition in deposit markets, but there is questions about how much. We've authorized 37 new banks in the course of the last 5 years, but they're still relatively small. There's still relatively high concentration in the sector.
What share of the market do they represent at the moment, roughly?
The big five, I mean, a big six, I would say around 3/4. Yeah. So it's it's substantial. Now, the question is, what are other forms of alternative savings products and other forms of competition, and what's going to happen in terms of a couple of structural developments that we in the government's been working on. One, the ability to port your data under GDPR, so you can, and secondly, the consumer switching costs, those being taken out, and also just using various platforms and even things like, and maybe I should hand back, things like the reforms we're doing for the so-called RTGS, that system, which is the core of the payment system. We're allowing new competitors to bypass banks and come directly into it. Mm-hmm. That's one of the ways to get more competition into the market for funds for individuals. But when you have a market that is that concentrated, and I will say it's similar in Canada, it's similar in Australia, you need to make quite substantial moves on the competitive side to see a shift.
It's quite interesting. In the bank's June inflation report, you had a chart which showed the spread around the base of mortgages since 2005, and pre-crisis, pre-07, the spread was much narrower than it is compared to today, which would suggest that competition pre-crisis was somewhat higher than it is now. I don't know whether that's fair. Is that a fair interpretation?
I think I would ascribe that more to a misplaced euphoria in the mortgage market, because that was class. I mean, remember, these are spreads, including spreads for very high loan-to-value mortgages, so 90%, 95% LTV mortgages that were very tight, were quite frankly mispriced as subsequent events determined. And so what we have seen is that, so I think it's more that than it was more competitive. I mean, it was competitive, but it was sort of stupid competition,
Indeed.
if I may put it that way.
Reckless.
And I think, unfortunately, the taxpayer picked up the tab for a lot of that stupid competition. Think Northern Rock, Bradford, Big, a series of others. Now, what we're seeing, and I don't want to be absolutely conclusive, but I think it's my personal view, this is directionally right, which is that in the mortgage market, we have better competition. So it's not all going to extreme underwriting standards. Underwriting standards are being held up in part because of FTC action. But what we're seeing short term, and I'll hand back to you, is that the ring fencing of banks, retail banks, which is a structural reform, has meant that there are pools of liquidity that are adjusting and are competing more in a mortgage market that is relatively soft, because the housing turnover is not as high as it has been in the recent past, and so there's more competition for fewer mortgages. That's helping to keep a lid on overall borrowing costs.
One final question to you, and I might turn it over to your colleagues, which is to say, if there weren't to be an improvement in the transmission of rate changes through to the consumer, and efforts to stoke competition in the market didn't gain meaningful traction, at what point in the future do you think you might need to revisit some of those questions, or to which indeed the PRA might need to revisit those questions? I mean, obviously this can't continue indefinitely. I appreciate that some of this is just the very long-term resolution of a very serious crisis, but at some point we have to say the sector's got to do better than this. Yeah,
I think there are two things. If I may make an MPC point just while I'm here on that, is that this is a very important issue. From an MPC perspective, though, the actual demand stimulus of higher interest rates to demand in the economy, or the effect on demand in the economy, is relatively modest. There's a much bigger impact of the reduction in demand, the headwind to demand, of the increase in the cost of borrowing. So just so we're clear. At what point? Look, I think that we have got to a period where we have dealt with the underlying issues of the crisis. We're getting to ring fencing will be implemented as of the end of this year. Major Brexit decisions will be taken over the course of the next several months. And a lot of work is being done by the Treasury, also at the bank, in terms of thinking about, I'll call it fintech, but that covers a variety of activities, but the new elements of the domestic financial system. You bring all those together, there's a natural point at which, regardless of where interest rates are and where these spreads are, it's sensible to look at the competitive dynamics in the market, because some of the big structural changes have happened, right?
Yes.
Brexit, ring fencing, the whole post-crisis reform program, and the collective, we are potentially embarking on some of the structural changes that could come from new technologies.
No, indeed. And I think it's in the sector's own interest that it does that, in terms of the confidence that it carries among the public.
Yeah.
And there will always be those, we've heard about 3% productivity targets. I mean, there will be those who will come with a much less market-friendly appetite if we can't get the banking sector into a more amenable situation when it comes to actually delivering for the public. Professor Tenrera or Mr. Haldane, do you have any points you want to raise about the transmission of interest rate changes through to the consumer? And in particular, whether just I suppose with a particular focus on whether there are any obvious steps which we could take to try and improve that.
I mean, Mark pointed out there is something of a disconnect now between the way the lending side, the mortgage market, and the unsecured borrowing market is now functioning, which appears much more contestable than was the case pre-crisis in a healthy way. And the deposit side, the liability side of banks' balance sheets, where there's much less evidence of that being true. For now, we can tell a story about correction from past extraordinary situations, but there will come a point where that question is begged. I mean, one reason it might be different, of course, is that on the lending side, you're talking about a relatively smaller number of people with relatively large loans.
Yeah.
Whereas on the deposit side, it's a large number of people with often relatively small amounts of money, which may mean they're less likely to switch and toggle between rates of certain types.
Yeah.
If that is the case, it's about that, in the words depositor inertia, as distinct from industry structure. That points to a different sort of set of solutions. And within that, I would mention just one, which is open banking. I think open banking, originally nudged by the CMA, could indeed be transformational. And the UK, in a way, is blazing a trail on that set of it. It's too early to tell quite how that will affect behaviour among depositors. But I'm hopeful that could be potentially a significant leap forward for the industry.
Just a very quick addendum on that, because I think it's absolutely right. And so the question is, what else structurally needs to be done to make open banking truly flexible and seamless, so that there can be aggregators that potentially sit above the banks and allow the individual who doesn't want to spend all their time deposit rate shopping, but actually have somebody else do it for them, and it meets anti-money laundering, counterterrorism financing, other statutory requirements in a seamless way. Part of that is with identifiers, portability of data, so having that structure in place. The last point I wanted to add, though, is what we have done is to think about what that open banking, if it really takes off, what it potentially means for the health of the banking system, so that we can put the sort of existing banking system in a position where it is not an impediment to this rolling out if it really does gain traction. And that was in what's called the exploratory scenario that the FPC did last year with the PRC.
Right.
Yeah.
Thank you.
Thank you very much indeed.